Good morning, everyone, and welcome to our Autumn 2024 Economic Forum. This is where we're going to present our UK and global outlooks. My name is Stephen Millard. I'm the Deputy Director for Macroeconomic Modelling and Forecasting here at NISA. I'm going to kick off and say just a couple of things, but then we're going to pass on to our experts who are going to present the outlook for the global economy. That's Barry Naisber, and Max Mosley on the outlook for the UK economy, and Arnab Bhattacharjee on the outlook for UK regions and households. Well, I have to say, this is an unusual outlook in that there are a whole heap of things that are all happening at the same time, some of which we were able to take account of, some of which we weren't. The first of those was the budget, that happened on October the 30th. We unfortunately had to close our forecast before the budget was given, but we have in our outlook attempted to explain how the budget may well have affected the forecast that is in the UK economic outlook. Then, of course, we had the major event on Tuesday of the US election. And that will have distinct implications for the global economy, some of which actually we covered in our global economic outlook, and Barry will talk about that. The final thing was the Bank of England's Monetary Policy Committee. They met yesterday and decided with a majority of 8-1 that they would cut interest rates. Well, we made that call ahead of time when we were preparing our outlook. So that decision, which was the one we were expecting, has not made any change to what we're about to present today. Okay, so with all of that background out of the way, I'm going to hand over to Barry, who's going to tell us about the outlook for the global economy.
Thank you very much, Stephen, and good morning, everyone. Thank you for joining us. As Stephen said in his introduction, I'm going to talk about our latest forecast for the global economic outlook. I suppose we should say that, as Stephen mentioned about the UK, we finalised the forecast in mid-October, so it doesn't incorporate all the most recent events. For example, the recent cut in the Fed rates, although we had that in as a forecast as opposed to an actual event. The forecast, as ever, is a result of a lot of work by a group of people, names on the slide there, and my thanks to them for all their hard work. And as ever, we use our global macroeconomic model, NIGEM, to do our forecast. It's our main forecasting tool. NIGEM is a multi-country model, and we have many subscribers to the model. If you'd like to become a subscriber, do please contact us, and we'd be very happy to talk to you about how we could help you in that. If you want to become a corporate sponsor for National Institute, of course, please talk to us about that as well, and we'd be very happy to help you with that. So with that out of the way and how we get to it, what do we currently think about the global economy? Let's start with global economic growth. Our forecast, to be brutally honest with everyone, hasn't changed a lot since I presented at the summer forum back in August. We see global economic growth this year and next, and even in 2026, somewhere around 3 to 3.25%. And we're expecting a broadly stable picture into the medium term, with growth running around 2.75% to 3.25%, somewhere around 3% in the medium term for global GDP growth. Of course, those sort of figures hide a disparity, both within regions, so within advanced economies and within emerging economies, and also across emerging economies and advanced economies. So, for example, this year we're going to see growth in the US of north of 2.5% and growth in the euro area of below 1%. So there's got a range of experience there. In terms of what are the risks to the forecast, and I'll come more onto the risks at the very end, but obviously probably the big discussion at the moment is the risk to global growth threatened by rising protectionism. Now, I know that debate is currently really in terms of, in the recent days, in terms of the US economy and now to be President Trump's proposals on increasing tariffs, which he did again back in 2018. But again, we've also seen tariff increases by the European Union against Chinese manufacturers recently. And we have written about and talked about increasing global fragmentation more generally for a while. So that theme has become probably a bit more prominent. In terms of inflation, particularly in advanced economies, is close to targets, but upside risks remain, and I'll talk about those a little bit. And then finally, we've seen, I think it's fair to say, gradual interest rate cuts from the Fed and the ECB, and we expect that to continue. So let me just run through those with some illustrations. So on the left-hand side, you can see an OECD inflation forecast. We exclude Turkey from this. It's got very high inflation currently and last year, coming down towards 2%-ish, with a sort of, we feel, a relatively balanced risk around there. That means that there's scope for central banks to cut further, and we believe they will. In terms of upside risks, we did some work on the recent increase in shipping costs. As you know, we've seen a diversion of trade from effectively through the Suez Canal down to running past the Cape of South Africa. And that has increased shipping costs. And we have a little box in the outlook which talks about how shipping costs could affect inflation. We think something like a 10% increase in annual shipping cost inflation feeds through into about a 0.5 point increase in annual CPI inflation, but it feeds through with quite a lag. So the lag, we reckon, is 6 months-ish. And so on that basis, we expect caution from central banks, given the uncertainties about shipping costs with the Middle East crisis still ongoing. If we move on to interest rates, what we expect is more cuts next year. We expect the ECB to be at 2.25% in terms of the deposit rate by the end of next year, and the Fed to be somewhere around 3.25% at the end of next year. The sort of outlier amongst the G7 is clearly the Bank of Japan, where the weak yen and the higher inflation that we've seen, we expect to lead to slightly increasing interest rates going forward. And we expect, other things equal, the Bank of China, People's Bank of China, to remain relatively cautious about moving interest rates, and probably fiscal policy being the main tool used there to stimulate activity if it's needed. If I move on to global economic activity, our forecast, in terms of this chart, I have to say it looks rather boring. The bars are all about the same height and showing growth of around 3% in the world, slightly shy of 2% in advanced economies, improving a little in 2026 as the euro area starts to improve more. Emerging economies and BRICS, the projections there really are reflecting a slowdown in China, in growth in China, but also a slowdown from the very high rates of growth we've been seeing recently in India, coming off 7s and 8%. So that's the background, and that background really continues. We forecast it to continue, other things being equal, into the medium term. Of course, in terms of risks to the forecast, other things really aren't equal. And one of the things that we've been looking at is the discussion around tariffs in the US. So if we could move to the next chart, please. Thanks ever so. We have something we call a topical feature in our global economic outlook. The topical feature uses NIGEM model to run simulations. And so what we've done is run a simulation of, in a way as close as we can get it, we think, to what might be the possible rise in US tariffs. You'll all be aware that now soon-to-be President Trump, or I suppose former President Trump, has promised to increase tariffs particularly on China, but also globally. So what effect do we think they have? Our model is very much a trade-based model, so it's good for that purpose. And we would expect tariffs to have a negative effect on US GDP growth rates. You can see that on the sort of left-hand side. The negative effect is quite high in year one, and it dissipates as we go through to years 3 and 4. For China, the effect on GDP growth is actually slightly smaller, but it's still significantly large, so around 1% off GDP growth rate there by year 2. We've also had a look at what retaliation might do. Retaliation is a rather difficult concept to operationalize precisely, but we think retaliation by China and the rest of the world would lower US economic growth even further, or have a more negative effect on economic growth, but actually doesn't have that much of a different effect on China in our model. If we move to the next one, please. I suppose two issues are: what countries are most affected? Well, the biggest loser country that we find is Mexico, for obvious reasons, that its trade is very highly linked to the US, and also just the geographical proximity of sort of gravity models works through that way. But Mexico is also a relatively small open economy. And the feature of the countries that suffer or have the largest losses or immediate losses in our estimation is that they are small or relatively small open economies, and they suffer most. In terms of world GDP, US tariffs by themselves, if they're permanent, give you about 2% drop in global GDP over the longer term relative to what would be forecast. Of course, if tariffs were only temporary, then which is the black line on the right-hand side chart, then the effect is much smaller and dissipates over that period. In terms of the risks to our forecast, this is particularly for GDP growth, but also implies in some ways almost the reverse to inflation. So escalation of Middle East tensions, potential increase in US tariffs, and any spillovers from post-election uncertainties in the UK to the global economy. And of course, as we said last time, we're still sort of trying to watch the Chinese economy very closely. Since our last forecast, there's been a major boost to the Chinese economy by the authorities, but we don't think it will have, or our view is, it won't have that much of an effect of spurring further growth in the Chinese economy rather than protecting existing growth. Upsides? Well, the obvious upside, having talked about the downside of US import tariffs, is for a fiscal boost in the US post-election. And our simulation doesn't take that into account. Easing of commodity prices and productivity gains from artificial intelligence being more widely incorporated into production processes more generally. And then finally, let me leave you with our summary chart. You can see on the left-hand side global GDP growth running around 3.2%. Consumer prices, price inflation, I should say, falling from around 6% last year for the OECD, excluding Turkey, to around 2% 2026. We have US growth slowing and Euro area growth gradually increasing, and growth in China slower this year than last and slightly slower next year than this. And those are the main things that affect our forecast. Well, thank you ever so much for listening. And let me now hand on to my colleague Max, who's going to talk about the outlook for the UK economy.
Thanks, Barry. So I'm Max, I'm senior economist in the macro team, and I'll be taking you through the outlook for the UK economy with thanks to colleagues on the slide. So the overall picture that we're going to present to you today is, as Stephen has mentioned, this is pre-budget, although we do have some thoughts and comments on how the budget might affect our sort of central forecast, if you like. But the real key theme here is that the UK economy had a very strong start to 2024 and has fallen back a touch since. We forecast that situation to slightly improve into the future, but we will sort of comment on some of the predominant drivers behind that fall off through the second half of the year. On the budget itself, it did obviously raise £70 billion and is quite a large fiscal expansion, financed with £40 billion worth of tax rises. But overall, there is a sort of strong investment set of packages in there, which may have an influence on future growth. But outside of that, our projections are that short-run GDP growth is to be slightly more positive over the next 2 years, but not as strong as the first 2 quarters of 2024. Our overall view about growth is that trend growth is around 1.2%. The UK economy will sort of lag around that figure for the time being. Inflation is obviously back to target and under control, but we do project it to be at around 2.5% in the near term. Some of that is due to base effects and some of that is due to sort of geopolitical uncertainty, but we'll go into that in a moment. And we anticipate 3 more rate cuts next year. So for GDP growth, this is our projections with pretty large fan charts, which represent some geopolitical uncertainty. So those are mostly on the downside, which I say at the bottom here. So that's dragging on future UK GDP growth. But overall, we have 0.9% in 2024. You'll note that there was a very strong start to this year. We project that most of that was driven by the services sector, at least in the first quarter it was around half, second quarter was almost all of it, was driven by the services sector. And that has fallen back since, which has pulled down on overall GDP growth. But we do sort of expect that to increase a little bit into the future. The budget policies, it's difficult to say at this stage what exact impact it's going to have on future growth. We do know that was a sort of key justification from the Chancellor that investments today will lead to better growth in the future. But it is, like I said, quite difficult to exactly know what impact that will have. And of course, that isn't reflected yet in the forecast that you're seeing here. The OBR were fairly pessimistic about future GDP growth. We'll have to sort of see whether that is more reflecting the sort of horizon that they're looking at, or whether that is just because we need quite a lot of investment to get the UK economy ticking into the future. I said that trend growth is around 1.2%, so you'll see that in our forecast we do sort of oscillate around that trend growth for the time being. And yes, as I said, downside is the downside to our forecast is on the geopolitical side, and we'll just have to see where that goes. So for inflation, we do have quite a lot of upside risk, as you can see here, before we get into the number itself. Again, that is down to that same geopolitical uncertainty. Shipping costs have recovered somewhat from the large increases over the last year, and have stabilized pretty quickly, which is really good news, because if they had stayed at their somewhat high level, as Barry touched on and is touched on a lot in the global outlook, that could have had a not insignificant impact on CPI inflation. That fall since has reduced a lot of the uncertainty and reduced a lot of that downside risk. But that being said, there is still some uncertainty while there are wars being waged in the Middle East. So our view is that inflation will rise to around 2.5% in Q1 of 2025, but will sort of fall back next year. It is quite a volatile period to be forecasting inflation in, that is just reflecting some of the base effects, but also some of the sort of more structural changes in, for instance, the changes in the energy price cap, that is having an impact on inflation itself. So although it is fairly stable compared to the last 2 years, it is somewhat is oscillating around that sort of 2% figure and rising to 2.5% by the first quarter of next year. By 2026, though, we do project that situation will change and will be more consistently at the 2% target. So let me move on to the next one now, thanks. So for the, I think it's, can we go to the next slide, please? Thank you. So for monetary policy, we did obviously have a rate cut yesterday. That was in line with what we were expecting. So glad that we were right on that, given we produced our forecast just before. It has been, I think, a little bit more of a live debate about whether the bank would cut rates for the last few months. More reflects, it is difficult to know exactly when that unwinding would begin. But once it has begun, we do expect this sort of reduce in interest rates to be a bit more consistent. So it should be a fairly less uncertain picture. But we continue to believe that interest rates will settle at around 3.25%. By around 2026, there are obviously these same geopolitical risks that are driving inflation will obviously be then influencing how the rate path might continue into the future. But for now, we do expect it to be fairly consistent for the time being. Moving on to the labour markets, we have obviously seen pretty robust wage growth over the last few years now. Real wages have been uncharacteristically positive for some time now, which is reflecting pretty strong nominal wage growth and falling back inflation. Projecting into the future, we expect that situation to somewhat continue, but obviously slowly ease and come down from some pretty high levels of nominal wage growth, albeit quite slowly. So that's our sort of general view for strong wage growth. You will note that the Chancellor made some big changes to the national living wage and minimum wage. So the ambition has been stated to equalise the 18 to 20 rate with the adult rate. That will have a fairly meaningful impact on low wage earners at the sort of lower end of the age distribution. There is, I think, a fair concern that it may have an influence on, say, youth unemployment overall. Making it slightly harder for younger people to compete with older workers with more experience if there is a sort of same wage and they haven't got that competitive edge of having a slightly lower wage. That is a situation that really remains to be seen. It may not have a huge impact on overall unemployment, but it may be something that's slightly more acute for younger demographics. But overall, the sort of general increase in the national living wage will have a positive impact moving forward. But then if you put that next to the national insurance contribution changes as well, there may be a sort of a change to employment. But that being said, usually when minimum wages are introduced and increased, we don't normally see a huge impact or a detectable impact with employment levels. But just because this falls after a set of pretty large rises in the minimum wage, it may be that this change at the margin might have a bit more of an impact than we would normally expect. But again, that remains to be seen. So moving on to fiscal policy. So this was a key feature of the budget. So we'll get on to in a moment what those rule changes relate to and how it will impact future fiscal policy. But overall, there was a pretty large increase in spending, and that comes to be driven by changes in fiscal rules and some changes in taxes. One of the rule changes that has already been introduced was a current budget deficit, a balanced budget moving forwards, which we are projecting here to be met. So our forecast is slightly better than the OBRs, but at the moment they are sort of fairly consistently below target, which is good news, but only just. So a very small surplus in 2026-27, moving forward to the end of the Parliament of this, for this Parliament. So there was a change in the debt measures, which I'm sure people here are very familiar with. We wanted to just provide a slightly more detailed description of the choices that were available to the Chancellor, including sort of status quo. So you can see here what would have been included in different measures. Obviously, she went for PSNFL. I'm not going to use the sort of fun name for it, but that's the official name, which we'll go with for now. Another option that was available to her was public sector net worth. So you can see here that includes more liabilities, but it also includes more assets. So we think that would have been there had some advantages and some disadvantages to that too. On the advantages side, it means that it would have included the benefits of non-financial assets. So that would have been infrastructure. These are sort of the most growth enhancing, more so than financial assets usually. But that wasn't necessarily included. So there is a concern that we could be in a similar position in the future where fiscal headroom is low and there is a need to get investment up. But because we haven't yet included infrastructure or non-financial assets as a potential benefit, it would then be quite difficult to finance that kind of expansion. So instead, we went for public sector net financial liabilities, which is basically the same, just without those financial assets. So that is a going concern for the future. Again, whether this will remain the same or whether it will be something that actually does have a material impact remains to be seen. But we do believe that there were sort of other options available to the Chancellor. But overall, the change will be a positive one based on what was there previously. NISA has been calling for a change to fiscal rules for quite some time. Part of that is pretty well documented, that it has held back investment in the UK. So at the very least, this new change in freeing up quite a lot of fiscal space and financing new investment projects with that increased space is a positive move. So just finishing with our key messages, there is £70 billion worth of new spending in this budget, financed with quite a lot of new taxes, but also with a fair amount of investment through changes in debt definitions. What impact that will have on future GDP growth, we'll have to keep an eye on. But for now, we just project that the short run uplift will last for around 2 years. Our long run view for GDP is that it will remain around 1.2% and should be fairly stable around that figure. But again, there are sort of noticeable risks on the downside for GDP growth. For inflation, those risks are on the upside, but we do forecast that we will be just above target, but not necessarily too much of a concern for the Bank of England. We expect inflation to be broadly under control, which will mean that there should be around 3 more bank rate cuts over the next year. So I'll hand over now to Arnav, who will go through the outlook for developed nations and English regions.
Thank you very much, Max and Stephen and Barry before that, and good morning to you all. Our outlook for the UK households, devolved regions, devolved nations and English regions, which I am going to present now, is as ever work done by an amazing team whose members are listed there. Much of the talk with respect to the budget and the aftermath and the lead up to the budget has been about the economic inheritance of the new government, and much of that has focused on the broader fiscal side, but this has implications for the outcomes across the cross-section of UK households, as well as for left behind places. So in that respect, we pay some attention to the subnational here, and we find that there is slow and uneven recovery of household living standards and entrenched regional inequalities, and we highlight some policy priorities with respect to that. Now, coming first to the UK households, there are 2 important observations that we bring forward. One is about living standards and distributional differences, so particularly that despite wages increasing over the past year and a half, households in the bottom income decile have not really benefited from it. Many of these households are not in employment, so obviously that is one of the reasons. And the increases in national living wage and national minimum wage largely fall upon the second decile and not the bottom decile. In fact, living standards as measured by equalized real household disposable income on a household below average income basis are lower by around 20% for the bottom decile in 2024-25 as compared with 21-22. There is also a fall for households in deciles 2 to 4, so the bottom half of the distribution, but that is on average around 5%. Now, on this chart, you see that overall hit to household disposable income. And as highlighted just now, so the largest hit is on the bottom decile. What is also interesting is that there is some impact of changes in income tax and national insurance. Well, not so much changes in income tax, but national insurance contributions and income tax thresholds being frozen. But that impact is relatively small. So that is on the light pink there, right? So that is largely dominated by real terms fall in disposable income. Now, moving on, the second important observation is that not only is there a fall in disposable income, but living standards are going to recover only very slowly. In fact, our projections show that for an average UK household, they will not return to pre-2022 levels before the end of 2025-26. So there will be very slow recovery back to levels. In fact, for the bottom 40%, living standards will not recover before the end of 26-27. So there are increasing disparities across the income distribution, which are going to stay persistent. Now, that is on the income side. On top of income, of course, there has been larger hit to household finances because of price increases. Now, inflation is broadly getting under control now, but prices have stayed high and higher than the post-pandemic levels, let's put it this way. So how much does that hit household finances? Well, the hits are large in the bottom part of the distribution, as might be expected, because prices in food, energy, and housing in particular were rose more sharply. And these are important components in the consumption basket, more important components in the consumption basket of poorer households. In particular, housing, costs of housing has stayed high and are projected to stay high in the near future. Now, that then brings us to the implications of the budget. Low-income earners will, of course, see some benefits. 18 to 20-year-olds, as Max rightly pointed out, will receive a 16.3% rise in the national minimum wage, and national living wage will go up by 6.7%. But at the same time, on the other side, freeze on the personal tax thresholds until April 2028. Well, the timing of that, change or the freeze is interesting, and one can cast a political eye on that. But anyway, that freeze will mean an additional tax burden for the lowest 10% of earners of around £600 per annum. So all in all, the distributional picture looks quite grim and continuing to look grim over the near-run future. So what does this mean for devolved regions, devolved nations and English regions? Well, anemic growth, and that is going to perpetuate gaps between and within UK regions. In fact, we find very little evidence of sustained regional regeneration. and particularly deep gaps in public transport provision, but also in primary education, in housing, and various other aspects. And in this respect, we welcome the government's mission to increase investments, infrastructure investments, and other investments, public investments in different parts of the country, though the details are yet to be seen. In particular, if we look at jobs, pay, and productivity, one of the major economic indicators, so the major economic indicators with respect to living standards and local growth, significant regional discrepancies are there, as we can see from this chart here. And this chart shows the change from 2019 to 2022, and green is better, red is worse. So places in red, they are moving backwards over time, or have moved backwards over this period, 2019 to 22, and places in green have improved, right? So these regional discrepancies, they stay. And here we show it not only between regions, but within regions as well. And weak GDP growth and low productivity in most cities and regions outside London and the Southeast, the metropolitan parts of the Southeast, they are really emerging as a drag on UK aggregate performance, productivity, and growth. Now, I've said earlier that one of the major places where there has been substantial regress in terms of regional development has been public transport since the pandemic. So over the period 2019 to 22, here we see a large predominance of reds. That shows that public transport provision has shown the worst deterioration since 2019, and especially in the 3 devolved nations. Of course, COVID was a catalyst, but it was not necessarily the main driver of this change. Chronic underinvestment in roads, train, and bus services, as well as in maintenance of road conditions, was quite, critical. The budget tackles some of these gaps in cross-country train connectivity, but that is largely limited to England. And more investment in bus services is needed, not least because train connections are not that reliable in many parts of the country, including Wales and particularly Northern Ireland. Now, in addition to public transport, of course, there has been substantial regress also in primary school education standards and in housing in particular. Now, beyond economics, what about well-being and life satisfaction? Well, in terms of measures of happiness, anxiety, life satisfaction, and feeling that life is worthwhile, there is a little bit of a north-south divide, but where the South presents a slightly better picture. But again, one size does not fit all. There are parts of the South as well which have been lagging behind and falling further behind. There are some important exceptions, such as Cornwall and Eastern Scotland, which show some of the best and worst results, respectively. What else has been major change? So in terms of devolution, another important construct or important conduit of bringing about greater regional regeneration, there is minimal change over the period 2019 to 22. Well, some new devolution deals were struck and negotiated in 21 to 23, but they will take some time for these deals to take effect. However, over the longer period of time since 2014 to 2022, there have been notable improvements in local infrastructure and economic development coming through the devolution process. So devolution holds some promise in this. Moving on, our concluding thoughts then are low-income households have taken a disproportionately larger hit from price rises when also facing weaker wage growth. And we encourage specific policy actions towards bringing forward the unfreezing of personal tax thresholds, particularly at the lower end of the distribution, and well-tailored, evidence-based public infrastructure projects to bring about greater effects upon left-behind places. Thank you. Over to you, Stephen.
Thank you very much, Arnab and Barry and Max. Wonderful presentations. Now time to throw the floor open to questions. So as I didn't say at the start, but should have, if you could put your questions in the chat, then what I will do is I will call upon people to ask their questions, to unmute and then ask their questions. Okay, and I'm going to start with Zhen Ye, who has a question for Arnab. Zhen, we'll try and unmute you if you can then ask your question, which is directed at Arnab. Okay, you need to unmute yourself and ask your question. Perfect.
Hello, Stephen. My question is regarding, can you hear me?
We can
Yes.
indeed. Yeah.
Yeah, thank you, Stephen, and thank you, all the speakers. My question is about how the decile in terms of living standard is defined by ANAP, and is it by income or is it, by some other measures? And I have another questions, which is about that 70 billion increase in spending. Max say that infrastructure is not included in PS and D. So where does that, infrastructure spending come out from? I'll be very interested to know. Thank you.
Okay, Arnab, one for you and then one for Max.
Right. Okay. So thank you, Zen. That's a good question. I should have clarified. This is based on household income and changes in real terms since 21-22. However, in this household income, two things are happening. One is that it is equalized. So we are standardizing changes in household with respect to changes in household composition. Secondly, this is after housing costs.
So not including housing costs.
Sorry?
You have not included housing costs.
No.
Thank you.
No, it's the idea, Peter, is that real personal disposable income. So it basically it puts all your income together and then deflates by the price level to make it real. Real household disposable income, then having adjusted for household size, then also takes off what you need to pay for housing costs. And then real household disposable income is what's left once you've already paid for your housing.
Thank you, Stephen.
And with housing costs going up, as Arnab said, that's why real household disposable income has gone down.
Thank you.
Max.
Yeah, so thanks, Peter. That's a really good question. So there's sort of two things here. One is about fundamentally what your fiscal space is in a particular moment and what you use that space with. And a second one is how those rules constrain any sort of future financing for investment. So on the latter, public sector net debt and, well, actually, let's just focus on that. Public sector net debt doesn't necessarily allow you to net off the potential returns from future investments on both financial and non-financial investments. So if you wanted to build, let's say, a high-speed railway line between two major cities, it would be quite difficult to finance that if your fiscal headroom was pretty tight, because you would see all of the cost up front, but you wouldn't necessarily be able to say, well, it might cost 100 billion in over this next few years, but it will create 200 billion in future returns. So it will be able to sort of net out that potential effect. So that's one of the sort of big constraints with public sector net debt. The move to public sector net financial liabilities only allows you to net off the benefits of financial investment, but not necessarily infrastructure investment. So that rule still constrains I think, probably most important part of investment, which is infrastructure, but not necessarily for the financial investment. So putting that all together in the first point, which sort of then takes us back to how this impacts the budget, the increase in investment spending doesn't necessarily come from this change in the rule that allows you to sort of net off financial benefits. It's more of an artificial increase that creates fiscal space today, which they're going to use to raise money for infrastructure spending. But this sort of fundamental constraint remains in the background, even if it's not playing an active role today. So that's sort of why we are just sort of commenting on this as a potential future problem. But in the sort of short term today, the change will just create headroom, and you can spend that on sort of anything. So we would have preferred if there was a measure that included the benefits from infrastructure spending, but at the moment, like I said, it doesn't necessarily play a huge role.
Thank you, Max. Very helpful. Thanks.
Okay, I have someone called Paul with no surname, so it's just Paul who has a question for Barry. Paul, yes, you've unmuted yourself. Go ahead and ask your question, please.
Hi, Barry. It's Paul Lee. In the scenario where you look at Trump tariffs, what do you assume about retaliation from other countries? Do you have that or not? And how big? And what happens to the exchange rates, which will offset some of the effect if the dollar appreciates? And what happens to monetary policy? Thank you.
Okay, hi Paul. Thanks for the question. Good to hear from you. Hope you're okay. Let's take the second part of your question first. So the way we run the simulation is we let exchange rates move and we let monetary policy respond as well, per the sort of Taylor rules that we have in the model. And so effectively what happens is US exchange rate appreciates, there is more inflation generally. The Fed responds by raising interest rates. And in fact, in the topical feature itself, we have a little chart that shows sort of how much of the effect, it's quite difficult to say it is due to, but let me say it's due to the effect on the US of the Fed raising interest rates versus the Fed holding rates constant. And it's somewhere a third to a half of the effect is due to the Fed actually responding in terms of interest rates. That's the answer to the second part of your question. The first part, I think it's fair to say it's quite difficult to sort of operationalize retaliation. I mean, we have to make a sort of a assumption about what others do. So we just assume that others do effectively what the States has done, so that China increases tariffs more than the rest of the world against the US does. Does that help answer the question?
Yeah, I mean, I guess the risk is that other people retaliate and the US retaliates for the retaliation, and you end up with a much bigger loss than we've seen, which is already pretty substantial. Thank you, Barry.
Yeah, no, absolutely, Paul. It's quite a tricky one, and I think the other thing that we've been thinking about, but not to come to any conclusion about, because these things are all very assumption based, is something like, when might this happen? So our simulations are in terms of year 1, year 2, year 3, etc., rather than trying to say it will be next year or the year after or whatever. Because as we know, going back to 2017, when President Trump came to office then, the first tariffs didn't start till 2018. So that's just to try and give an idea of size of effects, as opposed to trying to batten down timing on it.
Many thanks both. I have a question here from Francisco. Francisco, do you want to unmute yourself and ask your question?
Hi, thank you very much. Oh, sorry, there's an echo. Thank you very much for this wonderful presentation, as always. My questions, Max has already addressed some of it, but I wanted to drill a little deeper, and it goes a little bit beyond the 12-month outlook. It's more structural. So I have two questions. One is on the investment side and another on the financing side. On the investment side, it's about the effectiveness of the investment. And I'm playing here a little bit of devil's advocate. I think there is broad agreement on the need for investment. Even the most radicals agree on that. Now, with a reasonably dysfunctional labor market and with a reasonably dysfunctional supply chain in the UK post-Brexit, how realistic is it that anyone can execute effective investment in those situations? And I mean, I think HS2 is the most notorious of the examples, but the list is extremely long. How do you factor that? What's your view, first of all, and how do you factor that into your projections? Second, on the financing side, isn't this game of redefining fiscal limits that a bit of a fool's game when there is a humongous elephant in the room of state pensions, quasi-pensions like some forms of benefits that are permanent and can hardly be changed? Isn't these a bit of like cheating, playing solitaire, and not winning in any way, just buying time? Again, I'm playing a little bit of devil's advocate here. Just wanted to push you a little bit, see how you think about this. Thank you.
It's a great questions, Francisco, as always. I would before allowing Max to speak, I would just query the idea that the UK labour market is dysfunctional. Many people, including myself, would argue it's actually one of the best functioning labour markets in Europe, but certainly the most flexible. Anyway, I'll let
me qualify that. I'm talking about labor productivity as a long trend. Okay. That's the reason why I call it dysfunctional. It takes several men to do one person's job, basically.
Okay, so it's the low productivity side of things. Okay, that makes more sense to me. Max, off you go.
So perhaps I'll let Stephen answer the sort of the question about pensions, the second one, but I just wanted to focus a bit on this really important question about what can we expect from investment today. If to sort of rephrase your question in a way is to look at the labour market and see that unemployment is so low, that where is the sort of slack that extra government consumption can then generate extra demand with if there is not a sufficient supply of available workers. I think when we think about investment, there's sort of two sides of this. One is whether we need to sort of stimulate the economy with extra demand in the short term. And the answer to that in this situation is probably no. So the potential benefits from that are going to be limited. But then the second part of investment is always about creating a space for business to invest themselves. And business investment in the UK has been quite low for some time. I think you can have a really healthy debate about exactly what that is. I think low public investment will be playing some role in that. We can dispute how much of a role it is playing. I'd say it's probably quite a large one, but others may take a slightly different view. And I think if we talk about HS2, if you are an international business who's looking to invest in a particular country, the way in which HS2 has been handled and the sort of doomsday sort of commentary that has gone with it, and we sort of talked ourselves out of future investment projects like that, it doesn't exactly inspire confidence from international investors. So it could be a situation where if the UK doesn't want to invest in itself, then the businesses don't want to sort of follow suit. So I think that is sort of a really critical part of this. So we can sort of see potential benefits from public investment in terms of almost crowding in that business investment, but in the long run. So your question, I think, more relates to whether it will have a short-term impact. And for the reasons that you outline, I think the answer is probably quite limited. But the long-run implications should be sort of really understood. Now, the thing that we always talk about as sort of economists in the UK is investment. And as you say, we are all sort of in agreement that there needs to be greater investment. We shouldn't also see it as a panacea for creating future growth in the UK. There are other policies as well that are really important that are also holding back growth, and those mostly relate to planning and sort of restrictiveness around building and generating new infrastructure. That is another really important part of this. It doesn't necessarily relate to fiscal policy, but it is something in the background that could also then enhance future investment. So at the moment, I think just the fact that we're investing is a good sign because it's going to crowd in the business investment, but it's not the sort of sole thing that the government can do. So I'm sort of looking at this budget more in terms of a sequencing of policy changes rather than this being the sole change that will change the UK's economic prospects. Putting this against, future planning reforms, maybe future investment as well, I think we probably will see a slightly better future. I've just seen in the chat, Paul Mortimer just mentioned my favorite example of this, so I'm now going to steal his thunder and say it myself, which is that the Lower Thames crossing in the UK cost twice as much to create the planning documents for than the Norwegians spent on building the longest tunnel in the world. And so I think that sort of speaks to the sort of what it is like to invest in the UK at the moment. And changing that will be as much of an important factor as changing investment and spending rules.
Okay, I've been thrown the what do they call it? Suicide pass or whatever it is of the pensions thing. So my understanding, Francisco, and I'm quite happy for anybody on the line who understands this better than me, is that the new definition of net government debt adds essentially illiquid financial assets and liabilities to the previous definition. So pension liabilities of the government, which were essentially illiquid, I guess, have now been included. But then more importantly, the assets of the government's pension funds, in particular the local government pension fund, that's now been included as a positive netting off against illiquid liabilities. So my understanding is that pensions are now in on both the asset and liability side of the new measure of net government debt. And the key point, as Max has made, and I'll make it again, is that we're not yet at public sector net worth because physical assets such as roads, bridges, railways, etc., have not been included. James Nugent has a question. James, do you want to unmute yourself and ask the question?
Hi, can you hear me?
We can, just about. Quite quiet. But... Oh, you're mute again.
Sorry, can you hear me?
We can now, yeah.
Sorry about that. I was just wondering, have you considered the possible impact of a cut in the US corporate tax rate on the UK economy? I mean, it's one of the other possible spillovers from an incoming US government, and Trump has, I think, pledged to reduce the corporate tax rate to 15%. What are the possible implications, say, on UK economic activity via inward foreign direct investment from US companies?
Thank you. The quick answer is no. from the point of the UK economy. Barry, I don't know if you have thoughts on how you think that might affect the way we think about the US forecast.
I was just going to say, I mean, I saw the question, and I thought no was the correct answer, but I think it's a difficult one. I mean, you know, I guess we have to ask ourselves two questions. What effect would a reduction in the corporation tax in the US, I should say, have on US investment, generally speaking? And what effect would it have on US investment flowing overseas? And I guess at the moment we don't have the answers to either of those. If anyone on the call does have the answer to those, I mean, the whole issue of the effect of corporation tax on firms' investment is a well-researched one in public economics, and is a sort of almost undecided one in public economics, I guess. We do know that countries like Ireland that lower it to almost zero benefit enormously, but I guess we're not terribly sure about what 20 to 15 takes you, sort of thing. But if anyone's got any thoughts on that, we'd obviously be very, very interested to hear them.
Thanks for that.
Thanks, Barry. I mean, Ireland, as we know, is is doing very well out of having low rates of corporation tax. Because the big issue is what would happen if there were tariffs imposed by the US on the rest of the world, including Europe, and then the European Union retaliated in some way, shape, or form with something aimed at the big American tech companies, how that would affect Ireland. It's a very interesting question, I think, which we have not, I have to say, done any thinking on. But I think it will be interesting to think about that. I'm going to just pull off one more question because we're almost out of time. where did I see it? Somebody called Dennis. Dennis, do you want to unmute yourself and ask your question, please?
Hi there.
Hi.
Hello, can you hear me?
Yes, we can. Thank you.
Oh, good. Sorry, mine was just a general question, given these big pledges of private investment that the government have been promoting. I know it's obviously too early to say to degree, but long-term wise, how much of impact might that have on some of your modelling in the long term rather than medium term? If it's possible, of course, to all. Sorry, go on.
Yeah, Max, do you want to have a go at that, or
I just missed the question. Sorry, was there something
Yes,
was raised?
what do we think? What do we think of the long-term effects of extra investment
Private investment
and private investment?
Pledged 63 billion.
So I think we don't normally distinguish a huge amount in terms of the potential impact of private versus public. I think you can sort of make a reasonable argument that there should be a stronger effect from private investment, given that it should sort of directly relate to the productive capacity of a firm. But in the forecast, we don't normally make that sort of distinction, and the multipliers are sort of broadly the same. Yeah, so it sort of remains to be seen. The debate around investment multipliers, both public and private, is a pretty hot one at the moment, and I'm sure many on the call have seen. There is a pretty live discussion about whether the assumptions in the OBR forecasts are sort of allowing for sufficiently high multipliers that we would probably see in reality. But that is, I think, something that again sort of remains to be seen. Sorry if that doesn't necessarily answer your question, but that's just how we do it internally.
Yeah,
just a hypothetical question. sorry, go on.
I was going to say, I mean, we can model it, and indeed we do try to model it. The big question in my head really is whether we will actually see that increase in investment or not. It does rely on having the right conditions for businesses to make that investment, and that's probably just as important as the actual number itself.
I guess these are pledges as well, aren't they? They're just pledges.
Yeah, exactly.
They don't materialise necessarily.
Okay. I was going to look at one more question on AI from Bob Bradley, but that's been answered in the chat. Basically, the question was, have we seen any effect from AI on productivity numbers? To which the answer is, well, we had Philippe Aghion, who's probably the world's expert on all of this stuff, give a lecture at NISA recently, the Price Lecture. I would highly recommend it. Philippe is a phenomenal lecturer, and it was a great event. And Neil has very helpfully put in the chat the link for that. So anybody interested in AI, productivity growth, etc., please do go have a watch of that. In the meantime, I would like to just close by thanking our panelists, Arnab, Barry, and Max, for excellent presentations and excellent answers to a lot of questions. And more importantly, I would like to thank all of you for joining us today at our Autumn Economic Forum. We look forward to seeing you in 3 months' time for our Winter 2025 Economic Forum, if not before. Until then, enjoy the rest of the day. Bye.
Thank you. Bye.